There are moments in history when the world economy doesn't simply slow down, it breaks. 2008 was one of those moments. Banks collapsed, jobs disappeared, homes were lost, trillions of dollars vanished in months, and the global financial system came within inches of total failure. But this story didn't start in 2008. It started with a dream. For decades, owning a home meant you had made it. It was a symbol of stability, success, a normal life. So governments, banks, and families all shared the same belief. Everyone should be able to own a home. A dream that sounded good, reasonable, hopeful. But over time, that dream became something else. First, it became a business. Then it became a market. Then it became a machine. A machine that no longer cared about families, neighborhoods, or whether people could actually afford the homes they were being given. Only one thing mattered now: profit. Banks realized something powerful. If millions of people wanted houses, and houses required mortgages, then mortgages could be turned into money. But millions of people did not qualify for mortgages. Many had low income, unstable jobs, debt problems, or low credit scores, people who were considered too risky, people the banking system used to reject instantly. Until the early 2000s, because during the housing boom, banks asked a different question: what if we give them loans anyway? These became known as subprime mortgages, high-risk loans given to people with poor credit and low financial stability. Banks knew these people were likely to default. They knew many couldn't pay. They knew the math did not work. But the banks didn't care. Because they weren't planning to hold the loans, they were planning to sell them. Once the loan was approved, the bank got paid. Whether the person could afford it or not no longer mattered. That was someone else's problem now. And this is where the system turned dark. Banks began bundling thousands of these risky loans together and selling them as financial products called mortgage-backed securities and CDOs, collateralized debt obligations. It was like taking thousands of weak, unstable loans, mixing them together and telling the world, don't worry, together they're safe. Credit rating agencies, whose job was to protect investors, began stamping these products as AAA, the label reserved for the safest investments in the world. Even though inside those products were loans given to people who had no stable income, were already in debt, or had never been financially responsible enough to handle a mortgage. But investors didn't look inside. They trusted the labels, and that trust poured trillions of dollars into the housing market. Retirement funds bought them, banks bought them, governments bought them, investors from around the world bought them. Everyone believed the same thing. If the label says safe, it must be safe. Meanwhile, house prices kept rising. So banks convinced themselves that mortgages were always safe because if anything goes wrong, the house can always be sold later for more. This belief that home prices would always rise fueled the bubble. More loans, more buyers, more demand, more price increases. And because houses looked like guaranteed profit, banks became even more reckless. They began approving loans with almost no verification at all. Loans called ninja loans: no income, no job, no assets. Loans where the customer didn't need to prove income, didn't need to prove employment, didn't need savings, didn't need stability, didn't even need good credit. Approval became automatic. If you could sign your name, you could buy a house. The bubble kept growing, quietly, beautifully, dangerously. Then it happened. Interest rates went up. Suddenly, millions of people who had adjustable mortgages saw their payments increase sharply. People who were barely able to pay before now couldn't pay at all. Defaults exploded. People lost their homes. Banks foreclosed on properties. Thousands of houses flooded the market, and when supply rises and demand falls, prices collapse. The dream that had been sold to millions became a nightmare. And when homeowners stopped paying their mortgages, the financial products built on those mortgages collapsed too. Those AAA-rated investments, praised as safe, solid, untouchable, were now worthless. Their value didn't just fall, it disappeared. Banks holding these products suddenly realized no one wanted to buy them. Not for full price, not for half, not even for 1% of their original value. The collapse spread fast. Bear Stearns fell first. Then Fannie Mae and Freddie Mac had to be rescued. And then came the earthquake. Lehman Brothers collapsed. In a single day, one of the oldest and largest banks in America vanished. $600 billion in value, gone. Credit froze. Banks stopped lending to each other. Companies couldn't get loans to operate. Trade slowed. Businesses began shutting down. The global economy didn't just weaken, it stopped. The world was on the edge of a complete financial shutdown. So the US government and the Federal Reserve stepped in, and they printed trillions of dollars to save the system. Banks responsible for the disaster were rescued. People who lost their homes were not. The system recovered. The markets recovered. The wealthy recovered. But trust did not. And the consequences of that moment still shape our world today. Interest rates stayed near zero for years. Debt became the foundation of the economy. Wealth inequality accelerated. Home ownership for young generations collapsed. Financial markets grew bigger than the real economy. We live today in the world that 2008 created. A world where the economy runs not on stability, but on confidence, the belief that the system won't break again. But history whispers something uncomfortable. Every bubble looks safe right before it bursts, and somewhere, quietly, the next one is already forming. This is Echo Feed, where the future begins with understanding. Thank you for watching. If you found this video insightful, please give it a thumbs up and subscribe for more content that helps make sense of our complex world.